The Monetary Policy Committee, or the MPC, is set to come out with its decision on interest rates on Wednesday after concluding a two-day-long meeting. Now, according to a poll conducted by Bloomberg News, 40 out of the 56 economists who were polled believe that the benchmark repo rate is set to come down by 25 basis points. This would take the benchmark rate from 6.25% currently to 6%. However, what is the economic backdrop or reasoning behind such an expectation of these economists? That can be explained through the retail inflation chart. If you look at the consumer price inflation number, it has trended down to about 1.54% in June, which is below the 2% minimum target that the RBI has. Now, under the Monetary Policy Framework Agreement, the MPC is mandated to maintain inflation in a band of 4% plus or minus 2%. Now, let's say that the MPC does go ahead with a rate cut. Experts believe that the impact or the benefit of this rate cut would not be passed on to the economy fully because of a lack of private sector investment. Why is there a lack of private sector investment? Well, if you look at the capacity utilization number in the economy, it is trending at about 75%. Unless that number grows beyond 80–85%, it is unlikely that the private sector investment is going to come back. An important point also to consider is liquidity. See, in November, when the government announced demonetization, the system has since been grappling with a large amount of liquidity. The RBI has been conducting open market operations to absorb this liquidity. At such a time, if the RBI goes ahead with also reducing the interest rate, it could throw some confusing signals into the market. One last important point also to consider is the large amount of stressed assets on bank books. If you look at the minutes of the June MPC meeting, RBI Deputy Governor Viral Acharya has pointed out that probably high interest rates are justifiable in a situation where banks are grappling with large amount of stressed assets so that to avoid evergreening.